Hello and welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In this episode, we're going to explore a rather uncomfortable idea. Not about the markets themselves, but about the way investing is presented, packaged and sold. Because there seems to be a persistent human tendency, almost a perverse one, to take things that are fundamentally simple and make them appear far more complicated than they actually are. And nowhere is this more visible than in the world of investing, where a straightforward set of principles, save, invest in productive assets, diversify, remain patient, keep costs low, can gradually become transformed into something that sounds far more technical, specialised and inaccessible. Now, to be clear, financial markets are not trivial. They involve uncertainty, cycles, and genuine complexity. But there is a difference between necessary complexity and manufactured complexity. And today we're going to explore why that distinction truly matters. Because if something is genuinely too difficult for the average person to understand, then it creates a natural justification for intermediaries. Experts, gatekeepers, industry professionals. And that raises an important question. Is investing truly too complex for most people? Or has it been made to appear that way? So let's jump right into it. Sit back, strap in, and get ready to take on board another lesson in value investing, as inspired by Benjamin Graham. Let's kick off with a simple observation. Most long-term investors do not outperform the market. In fact, a large body of evidence suggests that professional investors, as a group, also struggle to consistently beat broad market indices after fees. For example, S&P Dow Jones indices, SPIVA scorecards, one of the most widely cited studies in the industry, regularly show that over a 10 to 15 year period, the majority of actively managed funds underperform their benchmark indices. Depending on the region and the time horizon, it is common to see around 80 to 90% of active fund managers underperforming their benchmark over 10 to 15 years in major equity markets like the US. And this is not a one-off anomaly. It is a persistent pattern across decades. Different markets, different cycles, different professionals, and yet very similar outcomes. Which raises a very uncomfortable question. If investing is so complex that it requires highly trained professionals, why do those professionals so consistently struggle to outperform relatively simple, passive alternatives? Now, one possible explanation is that markets are extremely efficient, that information is quickly reflected in prices, and that consistently outperforming is inherently difficult. There may certainly be some truth in that, but there is another layer worth examining, because the investment industry does not only exist to invest capital, it also exists as a business. And like any industry, it has incentives, and incentives shape behaviour. If clients believe investing is simple, low cost, and largely mechanical, then there is little reason to pay high fees for active management, complex strategies, or advisory services. But if investing is framed as highly complex, if markets are described as unpredictable, technical, and requiring specialist interpretation, then the role of the expert becomes not just useful, but essential. And that is a powerful position to occupy. This is where the idea becomes more controversial, because there is a perverse human tendency in many industries to increase perceived complexity, not necessarily through deception, but through framing, language, jargon, and structure. Financial markets are no different. You'll hear terms like alpha, beta, smart beta, factor exposure, convexity, alternative risk premia, multi-strategy overlays, and all can create an impression of sophistication. And sophistication, in turn, can create distance between the investor and the underlying simplicity of the economic reality. Because at its core, investing is still fundamentally about buying ownership in productive assets at reasonable prices and allowing time and compounding to do the work. But that does not sound exactly like a service that justifies layers of fees. So complexity becomes useful. Not necessarily because it improves outcomes, but because it helps justify the structure around the industry. This is where incentives become particularly important. The investment industry often promotes a simple narrative. We are highly skilled professionals. We analyse markets, we manage risk, we allocate capital intelligently, and in return, we can help clients grow their wealth. But here comes the uncomfortable tension. If these professionals are so skilled, why do they require other people's capital to generate wealth in the first place? If someone has a reliable edge in the financial markets, in theory, they could deploy their own capital and compound wealth directly. Yet most asset managers operate by charging fees on assets under management. Management fees, performance fees, advisory fees, transaction fees. And this creates a very different economic model, because in many cases, the business becomes less about absolute investment performance and more about gathering and retaining assets and generating fees. This is not to say that all professionals are misaligned or ineffective. There are genuinely skilled investors, and there are institutions that deliver strong long-term outcomes. But the aggregate data still raises important questions about the industry as a whole. Because if value is consistently being added, we'd expect to see that reflected broadly in performance statistics. Yet studies frequently show the opposite. Even more striking is that long-term outperformance is extremely rare. Funds that outperform in one period often fail to repeat that performance in subsequent years, which suggests that sustained skill is difficult to identify and even harder to maintain. So, returning to the central question, if investing is so complex that only professionals can do it, why do those same professionals so frequently struggle to outperform simple benchmarks? One explanation is fees. Even small annual fees compound significantly over time. A 1 to 2% annual fee may not sound large in isolation, but over 20 or 30 years, the compounding effect can meaningfully reduce returns relative to a low-cost index. Another explanation is turnover. Active management often involves trading, and trading introduces costs, spreads, taxes, and timing risk, all of which can erode returns. Meanwhile, passive investing removes much of this friction. It does not attempt to outguess the market. It simply participates in it, which is, in many cases, a surprisingly powerful strategy over long-term horizons. Now, it is important to be fair here. The argument is not that all investing is simple, or that no professionals add value. Nor is it that markets are easy to navigate in the short term. Volatility is real, cycles are real, risk is real. But there is a difference between complexity in markets and complexity in how markets are explained. And that matters. Because when complexity is exaggerated, it can discourage participation, it can create dependency, and it can shift the perception of investing from something highly accessible to something exclusive, something reserved for the experts. This is where the philosophy of investors like Benjamin Graham becomes particularly relevant. Graham consistently emphasised simplicity, margin of safety, rational valuation, emotional discipline. He did not believe investing needed to be mystical or overly technical for the average participant. Instead, he believed that ordinary investors could achieve satisfactory results through disciplined, structured, and understandable approaches. And this stands in sharp contrast to the idea that investing must always be complex to be effective. In fact, one of Graham's most famous ideas, Mr. Market, is deliberately simple. A metaphor designed to illustrate emotional pricing behaviour in markets without requiring complex mathematical frameworks. Now let's return to incentives, because incentives often explain behaviour more effectively than ideology. If the investment industry benefits from complexity, then complexity will tend to persist. If fees are charged on assets under management, then growth in assets becomes more important than marginal performance improvements. If clients believe they need constant advice, then advisory dependency increases. And over time, this can create an ecosystem where the perception of difficulty supports the existence of the industry. And the existence of the industry reinforces the perception of difficulty, a self-sustaining loop. So what should an individual investor take from all of this? Not cynicism, and not rejection of all professional advice, but rather clarity. Clarity that investing does not need to be made more complicated than it actually is. That long-term success is often driven more by behaviour than brilliance. And that simplicity, when combined with discipline, can be extraordinarily powerful. Because if something is truly understandable, it does not require mystification. And if something is truly effective, it does not require excessive explanation. As we begin to close out this edition, let's return once more to the central idea. There is a tendency in many areas of life to assume that complexity equals sophistication. But in investing, complexity is often mistaken for skill, when in reality, much of long-term success comes from avoiding obvious errors rather than engaging in highly complex strategies. And yet, the industry often benefits from maintaining the opposite perception, that investing is too difficult for individuals, that expert advice is essential, and that without professional guidance, success is unlikely. But the evidence on their long-term performance often suggests something else. That simplicity, patience, and low-cost participation have historically been extremely hard to beat, even for the professionals. That brings us to the end of today's episode. A look at incentives, perceptions, and structural forces that can make investing appear more complicated than it actually is, and why simplicity, discipline, and long-term thinking often remain the most powerful tools available to investors. I'm David Coombs, This has been Intelligent Investment Today. Until next time, stay safe and happy investing.